Let's start discussing some strategies that are suitable for futures day trading. In trend following strategies in futures trading, traders identify the direction of the market trend and make trades in that direction. This might involve buying in an uptrend or selling in a downtrend, often using technical indicators to identify these trends. What is the primary objective of trend following strategies in futures trading? The primary objective of trend following strategies in futures trading is to capitalize on market trends. These strategies aim to identify and follow significant directional movements in the market, whether upward or downward, to generate profits. The primary goal of trend following strategies in futures trading is to capitalize on sustained market movements. Traders aim to identify and follow significant market trends, buying in uptrends and selling in downtrends. This strategy is often chosen by traders seeking capital appreciation through market momentum. How do trend following strategies adapt to different market conditions? Trend following strategies are ideally suited for trending markets. They adapt by focusing on long positions in rising markets and short positions in declining markets. However, these strategies may face challenges in sideways or highly volatile markets where clear trends are less apparent. Trend following strategies are most effective in markets that exhibit clear and sustained trends, whether upward or downward. They are particularly well suited to volatile markets where trends are more pronounced and can be leveraged for significant gains. These strategies may not perform as well in sideways or highly erratic markets where clear trends are harder to identify. What is the risk profile associated with trend following strategies? The risk profile of trend following strategies involves managing the risks of trend reversals. These strategies may be exposed to potential losses if a market trend unexpectedly changes direction. Effective risk management techniques, such as stop-loss orders, are crucial to mitigate these risks. While trend following can be profitable, it comes with the risk of sudden trend reversals, which can lead to losses, especially if the trader is unable to exit the position promptly. The maximum potential loss can be significant if market trends shift unexpectedly and positions are not managed properly. Traders need to have a clear risk management strategy, often using stop-loss orders to mitigate these risks. What potential rewards can be expected from trend following strategies? The potential rewards from trend following strategies come from gains achieved through sustained market movements. By riding long trends, these strategies can accumulate significant profits, especially in markets that exhibit strong and prolonged directional trends. The reward potential of trend following in futures trading lies in capturing the gains from large, sustained market movements. The best case scenario is entering a trade early in a trend and riding it to its culmination. However, traders should also have realistic expectations, as not every identified trend will result in large profits, and the average expected return may vary based on market conditions and the trader's timing. What are the key steps and considerations in implementing trend following strategies in futures trading? Key steps and considerations in implementing trend following strategies include identifying trends and determining optimal entry or exit points. This involves analyzing market data to spot emerging trends, deciding when to enter and exit trades, and continuously monitoring market conditions to adjust positions as needed. To implement a trend following strategy, traders typically use technical analysis to identify potential trends. Key steps include choosing the right futures contract based on market analysis, using technical indicators like moving averages, moving average convergence divergence, or relative strength index to identify potential trends, determining entry points when a trend is confirmed and setting exit points or stop-loss orders to manage risks, monitoring the position closely and being prepared to exit if the trend shows signs of reversing. Traders also need to consider factors like contract expiry and rollover when trading futures. Scalping strategies in futures trading. This strategy involves making numerous trades to profit from small price changes. Scalpers aim to enter and exit trades quickly, capitalizing on minor market movements throughout the trading day. What is the strategic goal of scalping strategies in the context of futures trading? The strategic goal of scalping strategies in futures trading is capitalizing on small price changes. Scalpers aim to make quick profits from very short-term trades, exploiting minor price movements that occur frequently throughout a trading day. The primary goal of scalping in futures trading is to generate profits from small price movements. Scalpers focus on short-term trading, aiming to enter and exit trades quickly throughout the trading day. This strategy is typically oriented towards income generation through frequent, small gains rather than long-term capital appreciation. How do scalping strategies perform under various market conditions? Scalping strategies are particularly effective in markets characterized by high liquidity and volatility. These conditions provide numerous opportunities for scalpers to capitalize on small price movements. However, in less volatile and illiquid markets, scalping can be more challenging. Scalping is most effective in markets with high liquidity and moderate to high volatility. These conditions provide the frequent price movements and tight spreads necessary for scalping to be profitable. Scalping may be less effective in very stable markets where price movements are minimal. What risk factors are involved in scalping strategies? The main risk factors in scalping strategies include managing frequent trades and dealing with rapid market movements. Due to the high volume of trades and the quick reaction times required, scalpers face risks related to execution, speed, slippage, and the stress of constant monitoring. Scalping involves a high number of trades, which can accumulate significant transaction costs. The primary risk is the potential for small losses to add up if many trades go against the scalper. There's also the risk of rapid market movements causing larger than expected losses. Scalpers need a strict risk management discipline, often using tight stop-loss orders to protect against these risks. What are the potential rewards of employing scalping strategies? The potential rewards of scalping strategies come from the accumulation of small profits over many trades. While individual profits per trade are usually small, the cumulative effect over a large number of trades can lead to significant gains. The reward potential in scalping lies in accumulating profits from many small trades. While individual profits per trade might be modest, the cumulative gain over many trades can be substantial. Scalpers aim for a consistent win rate rather than large profits from single trades. However, traders should be realistic about the net returns after accounting for transaction costs and potential losses. What considerations should be taken into account when implementing scalping strategies in futures trading? Key considerations for implementing scalping strategies include the ability to make quick entry and exit decisions, often based on technical analysis. Scalpers need to be highly disciplined, able to react swiftly to market changes, and must have a solid understanding of technical indicators and short-term price patterns. Implementing a scalping strategy involves several key steps. Identifying highly liquid futures markets with sufficient volatility. Using technical analysis tools like candlestick patterns, level 2 data, or short-term moving averages to identify quick entry and exit points. Setting precise entry and exit points, often with automated orders like limit orders for entry and stop-loss orders for exit. Monitoring trades closely and reacting quickly to market changes. Considering factors like brokerage fees and market depth, frequent trading can lead to higher transaction costs. Scalping in futures trading requires fast decision-making, discipline, and the ability to react quickly to market changes. Traders interested in this strategy should be prepared for the intensive nature of the trading style and have the necessary technical setup for efficient execution. Using momentum trading strategies in futures trading. Traders look for futures contracts that are moving significantly in one direction on high volume. They then take a position in the direction of the trend and aim to exit the trade when the momentum starts to fade. What are the objectives of momentum trading strategies in futures markets? The primary objective of momentum trading strategies in futures markets is capitalizing on market momentum. These strategies aim to identify and trade in the direction of strong market moves, seeking to profit from the acceleration in price movement. The primary goal of momentum trading in futures is to capitalize on assets that are experiencing significant directional movement. Traders using this strategy aim to identify futures contracts moving strongly in one direction, often driven by high volume, and take positions to benefit from this momentum. The focus is typically on short-term capital appreciation rather than long-term investment or income generation. How suitable are momentum trading strategies for different market conditions? Momentum trading strategies thrive in volatile and trending markets. These conditions are ideal for capturing significant price movements. However, in flat or range-bound markets, these strategies might struggle due to the lack of strong directional moves. Momentum trading strategies are particularly effective in volatile and trending markets where significant price movements occur. These market conditions provide the strong and sustained directional moves that momentum traders seek. This strategy may not be as effective in flat or range-bound markets where price movements are limited and lack clear direction. What is the risk profile of momentum trading strategies? The risk profile of momentum trading strategies involves managing risks associated with sudden trend reversals. These strategies can be vulnerable to quick and unexpected changes in market direction, which can result in rapid losses if not properly managed. While momentum trading can offer significant profit opportunities, it also comes with risks, particularly the risk of sudden trend reversals or market corrections. The maximum potential loss can be substantial if the market moves against the position and the trader fails to exit in time. Effective risk management strategies, including the use of stop-loss orders, are crucial for mitigating these risks. What rewards can be expected from momentum trading strategies? Rewards from momentum trading strategies can come from gains achieved during strong market moves. When markets show a clear direction, these strategies can capitalize significantly on the sustained momentum, leading to potentially high returns. The reward potential in momentum trading lies in capturing gains from substantial market movements. The best-case scenario involves entering a trade at the early stages of a strong trend and exiting as the momentum begins to fade, thereby maximizing profit. However, traders should have realistic expectations, as not all identified trends will lead to large profits, and average returns will vary based on market conditions and timing. What are the key steps for implementing momentum trading strategies in futures trading? Key steps in implementing momentum trading strategies include identifying strong market trends and capitalizing on them. This involves using technical analysis to spot emerging trends, timing entries and exits effectively, and continuously monitoring the market for changes in momentum. Effective implementation of a momentum trading strategy in futures involves several steps. Identifying futures contracts with strong, sustained directional movement, often signaled by high trading volume. Utilizing technical analysis tools such as moving averages, trend lines, and momentum indicators like the Relative Strength Index, known simply as RSI, or the Moving Average Convergence Divergence, more commonly referred to as MACD, to confirm trends. Determining optimal entry points when a strong trend is established and setting exit strategies to capitalize on the momentum. Monitoring the trade closely for signs of momentum fading and being prepared to exit to protect gains or minimize losses. Taking into account factors like liquidity, contract expiration, and potential market moving events that could affect the trade. Momentum trading in futures requires a keen sense of market dynamics, the ability to quickly interpret technical signals, and the discipline to adhere to predetermined entry and exit strategies. Traders interested in this approach should be prepared for the fast-paced nature of this strategy and have the necessary risk management measures in place.